Hello, good morning, everyone. I'm Prateem. I'm a associate director with the direct tax practice in Anderson at UAE. With me is Tejas.
Hi, everyone. Good morning. Yes, I'm the corporate tax manager in Anderson UAE, and we are going to discuss a bit on the financial service sector.
Yeah, so today our discussion will be more around certain intricacies in the FS sector. And while this is a ocean, right, Tejas, and there are so many complexities involved,
Right.
we are more focused on three pillars. That is banking, insurance, and the investment funds and managers, and how would corporate tax impact them. And how we structured this session is also we have a small presentation where we'll speak on the law, and we'll speak on certain bits about the corporate tax law. But we've also got some feedback from our clients and our peers, and have collated a few questions that Tejas and I will ask each other and try and give the best possible answer
Yeah.
if we can, right? And so let us run the presentation now, and start the session.
Sure, Prateem.
So I think let's start with banking. Just hold on. Can everyone see the screen? Is it visible? Okay, I got a nod from Divina, who's a manager in our marketing department, and she's coordinating the whole thing. So she'll be giving us some prompts also. Yeah. So now let's start with the banking sector, right? And I think a lot of people are already aware, how banks were earlier taxed. So the regime was certain, foreign banks who had branches in UAE were subject to emirate level taxation, and this was a 20% kind of an income tax. There was also a certain computation mechanism involved where there were some allowances, like corporate head office expenses only allowed to up to 2.5%, and there were some restrictions on losses. So now what's happened is, with corporate tax, now how will it impact these branches or local banks, is that corporate tax is a federal law. What does federal law mean? It means that it applies to UAE as a whole, that is mainland and free zone. And this means that it will now supersede any prior legislation or an emirate level legislation. So going forward, all local banks would be subjected to the UAE corporate tax law, and branches of foreign banks would also be subjected to corporate tax. And the amount of tax, obviously, the rates and all will depend on your ultimate income. But this is corporate tax is now going to be applicable on banking activities. With this, let's take on some questions.
Yeah, I
Yeah.
think that's the thing which is like we have collated some questions from what we have gathered from some of the inputs we got from our clients.
Yeah.
And I'm going to throw some questions at you, Prateem. So, are you ready?
Yeah. Yeah.
So yeah, the first thing what we see here is like many foreign banks have a rep office or representative office, and branches are also there,
Yeah.
and they are currently covered in the emirate level taxation. How will they be impacted once the corporate tax law is kicked in?
And you mean a foreign bank having a rep office here and things like that?
Yes, yes.
Okay, yeah. So this is a question, everyone, that whenever we've had discussions with our clients or some targets, right? And what our peers have asked us is that currently, and this is a good question because the answer is difficult. Now, let's
Yeah.
take rep office, for instance, right? Earlier, foreign banks could set up rep offices in UAE, and and they were also governed by, say, you have your central bank legislation,
Right.
and they're regulated, right?
Yeah.
Whether in your DIFC, you have DFSA, in ADGM, you have your FRSA. And these allowed rep offices to be set up, but they used to mainly do marketing and soliciting business almost,
Right.
and selling the products of, say, their sister concern or the group entities outside. Now, these offices from a corporate tax perspective would be considered to be a permanent establishment. And what happens when you have a permanent establishment?
Yeah, I think
they could be taxed.
exposure to the income they're earning, right?
Exactly. But this could have a conflict with your, regulatory authorities as well, because this now people need to see in terms of, on one hand, if you have a P, transfer pricing kicks in. And what transfer pricing will say is that you need to allocate some profits to the functions of marketing that is being conducted by these rep offices.
Right.
Okay. And but can now rep offices earn income as per the regulatory authorities? That is the complications, and I do feel that banks and foreign banks need to reach out and seek a clarification on this front. A branch is a more straightforward case. Branch would be just a simple PE and whatever functions a branch is doing, and it's kind of, if the branch is today, not what you call, they're earning income, but but they're selling products as well. If the income is of the product, then the branch would be subject to 9% tax.
Okay, understood, Pradeep. I think rep office is something which is a tricky area. Branch, there's something where they would have more exposure to say a permanent establishment, but rep office is what
Yeah.
they need to see from what activities they are carrying out. Yes.
I think I have a much more interesting question here, Tejas.
Mm.
So, many people are already aware that banking activities is an excluded activity for free zone.
Yeah.
Let's assume that you're a bank in a free zone. And we have seen that there's a huge list presented to the is a
Yeah.
present. Just hold on. Yeah, I think all these activities, which basically bank does, is being covered under the restriction or something that is tainted, on which you will not get your free zone
Right.
benefits, right?
Right.
But my question is, would exchange houses be covered? Like, so if I'm a money exchange house,
Right.
would I be covered under this restriction?
Oh, that's a very interesting question, and also something to do with the banking activities which is listed out. So they have used the term banking activities and not specifically the institution as a bank or financial
Yeah.
institution. So, and if you see in the slide which is presented, one of the activity which is restricted is about the money exchange, money transfer, currency exchanges, which the exchange houses generally do, right? So this broadly seems to cover also the exchange houses, which are, by the way, also regulated by the central bank.
Yeah.
So they are already subject to certain regulations, and it's in the activity they are doing is included in the list. So it seems that it will cover cover the exchange houses here as well, and they won't get the free zone benefit.
So basically, Tejas, what you're saying is that banks are not covered, but banking activities are covered.
Right.
And within those activities, money exchange is something. So it
Right.
seems to be a
It's
restrictive thing.
right, right. So they are not just restricting it to the bank as an
Yeah.
institution, right?
But here, just moving on, I've got a thought, right? Ultimately, I was posed this question just today in the morning,
Mhm.
right? So now I'm a foreign bank. I have a branch doing normal banking services, but I also have an office here, a branch or something doing wealth management or investment management.
Hmm.
Now we are all aware that wealth management or investment management services is something that is a qualifying activity per se.
Right.
Now what do I do? So I'll not get benefits from one hand. Now I have wealth management. So what do I do here?
Right. So I think, yeah, this is very tricky situation again because it's covered by an excluded banking activities are covered by excluded activities as well as there is a qualifying activity which is there. So
Yeah.
here it's important to understand the setup of the entity as well, whether it's a separate entity which is carrying out the banking functions in the nature of wealth management or it's a branch of the bank which is doing it. So here we need to see more on the setup which is there of the entity and how you can segregate these two functions, right? So banking functions, you will have to segregate with the wealth management or the fund management services.
Okay.
So here it's important to look at that front and then evaluate whether the exemption free zone benefit will be available or not.
I think let's move on to the next pillar.
Right. I think
In the interest of time.
yeah.
So when it comes to insurance, insurance is a very well established business or industry within UAE, and Now, what's happened is insurance is again like banking, something that is specifically excluded from free zone benefits. So if you're an insurance company within the free zone, you may not get those free zone or 0% benefits, but reinsurance is covered as a qualifying activity. So if you're a reinsurer and you're based in a free zone, you might get that qualifying activity benefit, and your income may be subject to 0%. But there could be certain complications here where, say, if you look to the right of the screen, where you have a reinsurer, giving a reinsurance policy to a primary insurer, right, and earnings, or safeguarding their risk. So the primary insurer will not get benefits, as you see, but the reinsurer, any reinsurance premium that it earns, could potentially get 0% corporate tax benefit on this. But say this reinsurance company is actually also gives out insurance policy. It only doesn't give reinsurance, it also gives out insurance policies. And here gets tricky when you have a mixed income, right? And you do reinsurance and insurance. There, while you have something which is subject to 0%, you have something again which is subject to 9% and could potentially taint your qualifying income benefits. So you'll have to see this part and see what is the how much income is coming from the non-qualifying activities, if it's more than 5 million or 5%.
Right. So this is the de minimis test which you have to see
Yeah,
here, right? That's
exactly.
again a very stringent test.
Yeah. I think we can get to
One of the challenges in the insurance sector is also that many MNCs have some captive insurance companies which is set up,
yeah,
and these companies only provide the services to its group entities or to
yeah.
its parent company. So how would you see this, whether it will be eligible to get the free zone benefit or not?
Yeah, so see, captive insurance company, let's get the concept, let's understand the concept. Captive insurance is something which is very prevalent in large multinationals. I think, around, if you see the Fortune 500 companies, like I think 85 to 90% companies have a captive insurance, subsidiary. So what they do is they create a 100% subsidiary, and a lot of the risks are insured by this subsidiary. This subsidiary acts like a normal insurance company where it has to abide by that country's laws and regulations, driving those insurance activities. Captive insurance. So if it's within the group and you're insuring your sister concern, it seems to now be covered on the headquarter services. And it seems like you can get a 0%, corporate tax benefit on that. So it's quite interesting.
Yeah, that's
to-
interesting because it's a separate activity which is covered, and
Yeah.
it's not under the insurance services, which
So
is
here, I think a lot of large, I think family groups who are quite large and diversified may think about setting up captive insurance companies and seeing whether, that is something feasible or not feasible, and seeing whether those benefits may be available to them or not.
true. True.
And coming to this, this is one aspect of 0%, right?
Hmm.
One thing that plagues banking, and which is very, it's not, there's not much clarity right now, which, regarding provisions. The law
Yeah.
is quite silent on it. And let's be honest, banking and insurance sector provisions are prevalent, right?
Right.
Some are statutory provisions, some are non-statutory provisions. So Tejas, is there clarity? Will they get deduction on all the provisions that they've made?
Okay, yeah. As you mentioned it, Prateem, yeah, this is a sector where provisions are very common, be it banking, be it insurance, because of and there are many regulations revolving around this, right? So
Yeah.
for a bank, there is a calculation which is given for a non-performing asset,
Yeah.
whereas for insurance, there are many statutory provisions around the risks which they are the risk which are pending, or the
Yeah.
risk which is not which is outstanding as on the balance sheet date. So here there is two fronts to it. As you mentioned, there are statutory provisions and something which is normal, which is not governed by any law.
Yeah.
So what we see practically is many a times where there is a statutory provision and there is a backing in the law. There's a calculation which is given. it's you can at least substantiate in front of the tax authorities and get the deduction of that provision. But the main problem based on our experience comes in the other provisions which are not covered in the regulation.
Yeah.
So there it's very difficult and tricky to justify on what basis you are doing it.
Yeah.
And this is something to look out for. Yeah.
Yeah, I think Tejas, I think you made a very valid point. While I think the law gives you an option to do it on an unrealized basis and
Right.
realized basis, sum and substance, I think if it's unrealized basis, you can take a deduction for all your provisions. That's the plain reading,
That's
right?
a plain,
But the
yeah.
catch comes in is that, like you mentioned, other countries, we've seen plethora of litigation whenever provisions are made on some judgment or subjectivity, where
Right.
management is taking a decision. So this option, especially
Right.
whether unrealized realized, needs to be now taken with careful consideration. And also just and one needs to seek at least an opinion or guidance
Yeah.
on this front, that what is happening in the rest of the world in a similar law, on a similar provision. How are things panning out, say in Europe or in rest of Asia? How are insurance provisions or banking provisions treated? And especially it's very critical because your tax computation starts with your
Accounting.
taxable income, and the law says that that needs to be computed as per IFRS. So here on one hand you have provisions made on the basis of IFRS,
Right.
and on the other hand you have an interplay between your regulations, right? So this is tricky, but while Tejas, I agree with you that this option needs to be thought through.
Yeah, I think as rightly mentioned, a cost benefit analysis for each of the provision needs to be done, whether to
Exactly.
go for the option or not.
But long term, do you think they just hear that, even if one, say, unrealized will have that segregation with statutory, non-statutory? I'm
Right.
just thinking that, long term, doing it on realization basis in such an industry, it
Yeah,
may
I
not
think
be.
it's not very practical for the banks to do it, to opt for this option, because it's generally they will have more of provisions, which is like an impairment, which will be on the expenses side of it.
And it'll be year on year,
Yeah,
right?
it will be year on year. So
Yeah.
it's not very practical, but again, it's very important to do a cost benefit because the option is to be selected for all the assets together and not, you can't pick and choose certain assets on which you do
Yeah,
this.
that's a very important point. So
Right.
once they select unrealized or realized basis, it's for the entire asset class, or it's just only capital assets. You can't pick and choose.
Right.
Yeah.
Okay, I have a very simple one, I think, in terms of insurance. But so whether insurance brokers will get the benefit, or the agents which are there will get the free zone benefits, or it's not available.
I think a friend of ours reached out to us, right?
Oh,
Because
yeah,
yeah.
I think
So so here it's a very good question. So while qualifying activity includes this wealth management, investment, managers and things like that,
right,
but your insurance brokers are not covered
right,
in qualifying activity. So if you're a free zone insurance broker, it's not part of your qualifying activity. While you might only give out your services to a free zone insurance company, then you can possibly maybe get some benefit because it's free zone to free zone. And
right.
if they're the ultimate consumers of that service, then you might. So if it's
Yeah,
free zone to free zone, it's possible. But if you're mainland, it seems that you have to pay tax on your insurance brokerage. But when you're free zone insurance broker, you have to see whether your customers are ultimately free zone companies themselves. But if it's a mainland customer, then I think it's quite tricky. Yeah.
understood. Yeah, I think this is very important. Which entity is getting that services? Is it a free zone or a mainland? So
I
I
think
think
we
we'll
can move on to investment funds.
right. We'll move. I'll just present my screen again. So yeah, broadly, again, investment fund is a highly regulated sector as banking or insurance. There are many regulations around it, be it in a free zone, be it in a mainland, or even overseas. There are regulations which are governing these funds. Basically, what a fund does is it pools the investor
Yeah.
wealth and then invests it into various asset classes, right? So it will invest into, say, shares or commodities or derivatives, depending on the type of fund
Yeah.
and the regulation which is covering it. So here it's very important to see the taxability of it.
Yeah.
But the first thing which you check in terms of an insurance investment fund is what vehicle the fund is set up. Like
Yeah.
what's the type of legal entity, right? If it's a, say, a unincorporated partnership or a trust kind of setup, then it will be seen as a pass through entity, and
Yeah.
it will be seen as a transparent entity the tax incidence will directly fall in the hands of the investors.
Okay.
So under the law, you won't see fund as a separate entity, and the tax incidence will go. But if the funds are set up as a corporate entity, which is
Yeah.
also very prevalent, there it's important to see the tax implications on the funds. But here, what the tax law does is they give an exemption for such kind of corporate investment funds
Okay.
to do it to make it equal and to be at par with the transparent funds, right? So this exemption is given. Of course, it comes with certain
Okay.
conditions in the law, right? There's nothing which you get for without satisfying certain criterias which are there.
Yeah.
So yeah, on the slide you can see there are few criterias listed, and one of the main criteria there is it has to be traded on a stock exchange. The interest in the investment funds has to be traded on a stock exchange, or it should be made widely available to the investors. So
Okay.
basically, it should be marketed well. It should not be a closed-knit fund, is what it's saying.
Okay.
And
Very interesting.
and also an anti-abuse provision is brought in here. So if you're just setting up a fund to get the corporate tax benefit, then
Yeah.
it's a big no.
So I think there's a very interesting point that you made. I think they just hear that, when you spoke about, and funds are something that has been around in UAE for some time, and it is something that a lot of financial service, free zones like your DIFC and EDGM,
Right.
it's been prevalent, right? Ever since they've been around, and it is really, really picking up. And across the world, right? Funds are taxed quite differentially compared to other sorts of
That's true.
entities. And even in a corporate tax law, there is a differential tax kind of a regime like Tejas has touched upon. But here I'm very interested in knowing, you spoke about usually across the world, there is a pass through kind of funds usually, but in UAE, you also have corporate structure for funds, right?
Right.
Usually it's a partnership where you have a general partner, limited partner, and things like that.
Right.
But here you have a corporate structure. So, what kind of funds are covered by this exemption, potential exemption?
Right.
And when you said that, you also mentioned that it has to be widely marketed to the general audience, or it has to
Right.
be traded. What does that mean, Tejas, practically?
Yeah.
Because can I now today just market it to 5 individuals or 6 individuals, and will I get the benefit? Has this term widely been defined?
Yeah, this is very interesting, Prateem, and a open-ended thing. So, open-ended question here because funds can be of various types, right? So, and one of the important condition, as you mentioned, is about marketing of the funds.
Yeah.
So, it's not defined in the law specifically whether you market it to a small group or a larger group, but what it says is it has to target a particular category of investors. If it's for a particular category, all the investors in that category should know that this fund is there, and it should not be close knit or a family kind of fund. So I think we can take a few examples of the funds which are prevalent here. I think the most common is a mutual fund which is available to public at large. Then
Okay.
so there I think it should not be difficult to satisfy this condition, but something like a family fund
Yeah.
where
That is quite common.
yeah,
Sometimes.
in
And it's
UAE,
picking up now,
yeah,
right?
it's picking up
Yeah.
in UAE as well
Mm.
because people want to have the wealth managed out of UAE, and they want to get this, they want to see whether they are eligible to get this benefit or not.
Especially because, see, one must appreciate that the UAE economy is unique, right? Because 90%, I think, of large business houses in UAE is family-owned businesses.
Right.
So when there are so many family-owned businesses, then criteria comes in into personal wealth management, and that is why
Right.
family funds come into play, right?
Yeah,
Yeah.
that's the thing. So, but family funds, it's tricky to satisfy the situation, right?
Yeah.
This condition because it says it has to be marketed to a wide range of investors. Even if it's not listed, it has to be marketed well to a larger group. So, family funds, it's obviously it's just
Yeah.
within the four corners of that family, and then you won't be going out to the public at large or to a group of investors, so as to say. So there it's very difficult to satisfy this condition.
So I recall that the public consultation document, right?
Hmm.
Before the law came out, the I just recall it had certain criterias as to how many people it should be marketed to, how many investors should be there.
Right.
Two investors cannot have more than this, cannot hold this much of the
Yeah.
entire fund corpus. So, but the law is not very specific, and
Yeah.
neither has any decision. Is there any clarity? It's absolutely no clarity.
No, so yeah, you rightly mentioned there was certain criteria around
Yeah.
50% or 30% of the of the fund which is not held by more than one person should not hold more than that amount in one particular fund. But the law again is very vague here. It's not clear. They have not given specific criterias in terms of percentages. So it's while the PCD mentioned it, the law does not have it. So
Okay.
we can't fall back on that.
Okay, understood. But I think we need to now look at more, but I think family funds would be a bit tricky, right?
Yeah, mostly they it may be difficult to satisfy the
Okay, I
situation,
have
right?
another question which I think someone posed to us recently.
Hmm.
Now, say if you're a investment fund based off DIFC, right?
Hmm.
And you're a fund manager, you know, in mainland or a foreign entity is a
Hmm.
fund manager. What will be the tax implications there?
So yeah, I think there because it's a fund setup in a free zone
Yeah,
DIFC. So while the exemption is available to both mainland and free zone, so a free zone entity can also apply for this
yeah,
exemption if it satisfies the condition.
yeah,
But the tricky part here is about the fund management services
yeah.
because that's one of the qualifying activity which is listed, which will get the free zone benefits.
Hmm.
And fund management services provided by a free zone will only get the benefit. The mainland fund managers or the overseas fund
Okay,
managers may not get the benefit. So here, for a fund which is set up in a free zone, having fund managers which is overseas, which is a common structure in UAE as well, there it may be difficult for the foreign fund managers to get the exemption on the income. So
okay.
generally, what we see is a fund manager will earn a typically income of a management fee or a performance fee, which is generally a percentage of the NAV. So there,
Or a
whatever
carry interest.
or a carry interest
Yeah.
they might be earning. So here, a free zone fund manager will get the benefit of the 0% rate, but a foreign or a mainland fund manager, it may be difficult to get the
It's
benefit.
very interesting. When it's a foreign fund manager, then it would be a state sourced income, right? That means they would
Right.
that income would be considered to accrue from UAE. But again, if it's state sourced, then we need to see how tax would apply because state sourced income is currently, we need to see because currently taxed through withholding tax mechanism,
Right.
and that needs to be analyzed further.
Right.
Right.
For a foreign
Yeah.
foreign fund manager, right?
Yeah.
I think I have one question for you, which is also as I mentioned, it's a transparent fund structure or an opaque fund structure where you're getting the benefit, right?
Yeah.
So at the fund level, mostly if you get the benefit, you won't be paying the tax. But what will happen at a investor level? Say an individual investor
Okay.
or sponsor is investing in the fund.
Yeah.
What will be the tax implications under the corporate tax law for them?
I think, like you had mentioned in the beginning, right?
Hmm.
So by opaque, I think you mean a cap, like a company,
A
yeah.
corporate fund, right?
And by transparent here, we mean a partnership where it's the look through, where the partnership as an entity will not be taxed, but you will have to see who are the investors,
Right.
right? And it will be taxed in their hands. And then comes in the play of natural person taxation,
Right.
right? Now, natural person, one of the activity that is not considered as business income is your your personal investments, right?
Yeah.
As long as you don't need a license. So but here I think the natural persons have to bank upon that personal investment argument that is a personal investment, and so corporate tax should does not apply to me, but this has to be analyzed from case to case basis,
Right.
right? And so but I think given that there are exemptions from the corporate tax structure, I don't think, from a at least a policy perspective, they would want to treat the natural persons any differently. But
Right.
it's more of an applying the law and interpreting the law in that way.
That's
Yeah.
correct. That's
Okay.
correct.
And I think with that, we are done with our session. Thank you all for joining us. We have tried to keep cover banking sector, insurance sector, and investment funds and managers. Like I had mentioned initially, it's a whole ocean. We try to take on some practical questions. But if you have any questions for us, please do feel free to reach out to us, and we can connect. And thank you for joining us.
Thank
Thank
you.
you.
Thank you, everyone.
Bye.
Bye.